Episode 800. That's right. This is a very special episode for a number of reasons. One, I want to thank all of our listeners for checking us out and being with us on this journey. The show originated as Target Market Insights, really focused on helping you identify the best markets and submarkets for real estate investing. And it has morphed more into Multifamily Insights since then, where we talk about all the things you need to have to be a successful investor. Well, today we bring back our very first guest, Tryfon Christoforou, who is one of the managing partners of 3CRE. And we talk about the market here in Cincinnati, how to find the best markets to invest, but also how to build and scale your team. When I met Tryf and had him on that first episode, it was really just him and his partner. I think he had one other guy. And now he has 42 agents and brokers on his team. So we're going to talk about how to thrive no matter what's going on in the economy, as well as any investing sector. So if you are looking to grow and scale your portfolio, this is a conversation you do not want to miss. It's episode 800 with Tryfon Christoforou right here on Multifamily Insights. Welcome to Multifamily Insights. I'm your host, John Casmon, and I want to thank you for joining us for another great episode. If you are enjoying this show and getting some great value for your investing journey, let us hear about it. And if you haven't done so, hit that follow or subscribe button. You do not want to miss an episode, but particularly this episode. I'm super excited about today for a couple of reasons. Not only do we have a phenomenal guest and a guy who's become a friend of mine, particularly in the Cincinnati real estate investing scene, but he also was our very first podcast guest. Today, we are excited to bring back Mr. Tryfon Christoforou. Tryf, how you doing, man?
Good, man. Good. Make me feel old with that intro there.
Hey, man, experience is what I like to say, man. We've been around the
Okay.
block a
Okay.
little bit, all right?
We're like
For those
wine.
who
We're like wine. We get better.
There you go, man. So Tryfon is the one of the owners of 3CRE, which is one of the most growing brokerage firms here in the Cincinnati market. We had you back on episode one. You helped us launch this thing. We talked a lot about the Cincinnati landscape and markets at that time. You've obviously grown a lot since then. Your team's up to 42 real estate agents and brokers at this point. So you've had a lot of success growing your business. We'll touch and tap into a lot of that. But for those listeners who are not familiar with you and your story, why don't you take 2 minutes to give us a little bit more of your background?
Yeah. So great. Thanks for having me on your show, John. I appreciate it. I think we're what 800 episodes. You said
This is
that you're
800,
kind of.
man.
Wow, it's come a long way for your podcast too, which is amazing. So I'm glad it's worked out. But no, my name's Tryf Christoforou, one of the managing partners, owners of 3CRE. Started the company or the partnership, actually. I'll get into the company, but we started the partnership with my partner, Mike Constantini, about 14 years ago. We then went fully independent exactly 10 years ago this fall. So we'll be celebrating our 10th birthday. So we're still in the toddler stage, infant stage, whatever you want to call it. But no, specialize in commercial real estate, multifamily, commercial buildings, retail, office, industrial. And then we've added other divisions over time, over the past 10 years. So we do business brokering. We've got asset management as well. So 3CRE Asset Management. And then we created residential post COVID too. So we've got agents that specialize in residential real estate, the 1 to 4 units. And then also recently, as of last year, we created the 3CRE Capital Markets brand too. So now we're helping our investors either find capital for new purchases or refinance existing capital they may have.
I love it, man. Lots of value there. And you talked about, 14 years you partnered with your guy Mike. Last 10 years completely independent, celebrating 10 years this year. So congratulations to you and your success. For this is a little bit of a throwback, man, because one of the things that I always loved is just one, how open you were with sharing information. We did that very first episode. I was really trying to learn about this market in general, or I should say
Mhm.
specifically, but in general, just what to look for. And my challenge at that time was I lived in Chicago. I was
Yeah.
interested in Cincinnati. My wife's from here. And every time I talked to a broker about any deal they had, they would sell the hell out of me, man. They'd tell me why this part of the town was best and, West Side's got great cash flow and this is that and this is where you want to be. And I get it, man. That's sales, right? You got to highlight the
Sure.
perks and the benefits, right? But I wanted more of an unbiased market assessment, and you were able to deliver that in that first episode. You laid out exactly where to look today, where you would put your capital. We talked a lot about the Montgomery corridor, And you really gave us
Mhm.
some great insights on the Cincinnati market. And I think to extrapolate that across the country, some insights of what to look for, no matter what market you're looking in, what to look for in those markets, right? So I love that. And I appreciate you sharing that. As you look at the market today, and let's stick to Cincinnati, and obviously we'll extrapolate this for folks around the country. How do you view the Cincinnati market as a whole? And where do you think there's opportunities for investors from a geographic standpoint?
Man, I tell you what, I mean, if you told me that, some of the prices we're selling properties for now in Cincinnati, when we had the conversation 14 years ago or 10 years ago when we did our podcast, I mean, it's doubled and tripled in terms of value. And we're still much more affordable than the rest of the country. That's the crazy part. So we've had significant growth. And give you an example, I just sold a building. It's a smaller building, 5 unit. I've sold that property now 4 times in 14 years, and each time the seller has made a good profit, good return. Um, so that kind of tells you where Cincinnati's at, and that's one example. We've sold numerous properties numerous times over the years because of the relationships we have. But Cincinnati in general, it's still very affordable. I always say this: we're a white collar town. We've got many, Fortune 100, 250, 500 companies that are headquartered here. Largest consumer homes brand company, Procter and Gamble, GE Aviation's here, Fifth Third Bank's here. Great American insurance companies here. Just companies. Company Paycor that just got bought out is here as well. So you've got white collar jobs here, and whenever there's jobs, whenever there's population density, you're always going to have a housing need. And we're still developing. A lot of downtown Cincinnati still getting developed, and we're still very affordable. We're $1.50 to $2 a square foot on newer stuff in terms of rent per square foot, while some of the East Coast cities, West Coast cities, Austin, Texas's, Nashville's, they're pushing $3, $4 a square foot, depending on the size. So again, you just get more bang for your buck here. The market, the demand hasn't changed. We're top five kind of demand in terms of investors with out of state guys. The prices have changed; they've gone up. So people in Cincinnati still say it's overpriced. And back in my day, it was 30,000 a door, and how are we paying 80,000 a door now? But the market has taken us there with the income. But because units are renting at $1,000 a month now versus $500 a month that they were renting for.
Man, I love it. You said a couple things there that I want to jump in on, man. The first is you talk about being a white collar town. That may be surprising to a lot of people, right? I don't know
Yeah.
how people think of Cincinnati and say that's a white collar market there. The Midwest as a whole kind of gets lumped into blue collar,
Mhm.
industrial, kind of those jobs, those industries. You talked about some of the companies that are here, with Procter and Gamble and Fifth Third and so many others. What is that perception, both inside of the Cincinnati market and as well as outside of Cincinnati? When you talk to those coastal investors, like what's the perception they have of the market?
Yeah, I mean, a lot of people do think it's a little bit of a small town feel, and Cincinnati in general is kind of a small big town. We call it. That's what I kind of call it when I'm talking to out of state investors. I mean, a lot of people know each other. A lot of the, a lot. There's not a hell of a lot of competition when it comes to even in the brokering world. There's a select few of people you run into them all the time, and it's not very dense in that sense. But you got to remember too, John, we've got three major league teams. We've got the Reds, we've got Bengals, we've got FC Cincinnati that's really taken off as well. There's a lot of momentum here. So when you're explaining it to out of state people, I always bring up sports teams. Everyone can correlate sports teams, whether they know who the Bengals are or not. If it's an NFL team, we've got two stadiums downtown on the river, and then the one in OTR. I mean, you got to bring that up. Uh, I always give statistics on the jobs and how many jobs are here. We've got really two major universities just in Cincinnati. You got UC, which is the largest employer in Cincinnati, and then you've got Xavier, which is a larger private school it's really known for its MBA programs and things like that. And then a 30-minute drive north, you've got Dayton, you've got Wright State, and then if you go an hour and 10 minutes, you're in Columbus, which is another kind of major investment market now that we do a lot of business in and have an office at. Ohio State University, who everyone knows who the Ohio State University is. So, being able to just correlate kind of those um, kind of, brands and schools and sports teams, and explain that to investors. Then they're like, wow, I didn't realize it was that big. So, And that's kind of the difference between us and maybe say Cleveland. And we've done a lot of deals up in Cleveland, but Cleveland just doesn't have the white collar jobs that we have here in Cincinnati and Columbus. And now with infrastructure being built, with AI centers being built in Columbus, and the Honda plant that's built on 71, and Purina that was just built in the eastern Cincinnati suburbs. Factories are also coming here, that these companies want to invest in this area. And again, it all correlates to investment. If you have density, people need to live somewhere, and businesses need to open, and that's what makes a healthy economy for us here.
Man, I love what you said, man. And as someone who was born and raised in Cleveland, and I bleed, Cleveland through and through. It pains me to say this and admit that you're right, but this is
Yeah.
exactly what we see in the data. And that's why sometimes it's good to take the emotion out of it and take your perception out of it and not just go with whatever you think of the market, but actually look at the data. And I mean, you talk
Hmm.
about some of the universities. You didn't talk about, NKU, right? Northern Kentucky University,
Yeah.
which is just on the
Sure.
other side of the river. You didn't talk about
Yeah.
Miami of Ohio, which is
Correct.
another, really prominent university. So there are a lot of different factors that drive it. And then I also think from a geographic standpoint, like you're close to a lot of the rest of the country. You're 2 hours away from Indianapolis, 2 hours away from Louisville. You can get, one, you got 71 and 75, so two major interstates that you can access. So from a transportation standpoint, a logistics standpoint, you can get to a lot of other places. So we've done enough selling of the Cincinnati market, right? We know what we like about it there.
Sure.
Let's talk about the submarkets. When we were talking, on episode one, you kind of helped me recognize that the Montgomery corridor was the ideal place to invest at that time. And so much to the point, I made sure the next investment I made was in that Montgomery corridor and bought a
Yeah.
property in Norwood. If you were starting over today, you're talking to an investor, they don't know much about Cincinnati, and you gave them kind of a sub-market or a corridor to zone in on, where would that be?
I still love the Norwood Montgomery Road corridor. I mean, I think if you look at the neighborhoods that even look at all the new development that's going on, like Norwood in general. And John, the first deal we did, we didn't do a deal forever, and then we ended up selling your 22 unit,
Yep.
and then recently you just bought another, investment property for yourself in Norwood that we just did a deal on. But I think look at all the neighborhoods around it in terms of what's been happening, what's developed. First of all, the Montgomery Road corridor, Pleasant Ridge. I mean, 12 years ago, 14 years ago, we were talking about that. Now that's really, real
It's
developed. I mean,
pop. Yeah.
yeah, we've got a listing here where we're developing a brand new Class A development that one of the local developers here with Town Properties that we're doing leasing for them, on a mixed use building that they've built. They've got retail on the bottom and apartments up top. 15 years ago, you would have never thought on Montgomery Road they'd be building, a multi-million-dollar project like that. Norwood is situated between Hyde Park. It's between Oakley, which those markets have changed too in the past decade as well. And then you keep going down as you get into Pleasant Ridge and Deer Park, Silverton, a lot of development going there. It was funny. I was driving down Montgomery Road the other day because I was heading to an appointment, and Wawa just opened up in Silverton. And you're like, man, Wawa came to Silverton? Like, that's amazing, they're no dummies. These retailers, these national retailers, they invest in areas they think there's going to be growth in and where they can support their business. It's not like, hey, we found a corner lot and we're going to put a gas station there. There's so much void analysis that goes into that in terms of opportunities, risks, population, household income. They're looking at all of that. So the fact that a major gas station like Wawa just opened up on Montgomery Road in Silverton is a good indicator. That's a good investment area. Then as you get into some of the eastern suburbs too, we've done a lot of deals. Your Milfords, your Lovelands, kind of those small town, little villages, things like that. Those have really started to take off too. There's new development going on there, and a lot of the owners that have owned there have owned for numerous years. So now we're starting to talk to those owners, and they've never really caught up with the rents. So there's a lot of opportunities in the Lovelands, the Milfords, the Amelias, the Batavias, which is kind of your Claremont County, the county next to Cincinnati's Hamilton County market that's really taken off. And then even if you go north now, the Coleraines, we've got a lot of retail that's we're representing, and we manage a property. It's a 15,000 square foot shopping center on Coleraine Avenue. They had a couple vacancies, and we had every national retailer. We just signed Nothing But Cake as one tenant. We've got a couple other national retailers I can't announce yet, but it's unbelievable. They're knocking on the door to come to these markets because again, they're following the metrics, they're following the income, they're following the households. the population. How are they going to support their top line sales? And then you mix that in with housing, where you can go there and invest in these multifamily or single family or duplexes, whatever you want to invest in. You know, you're kind of seeing it all come together. So I would say I've always loved Montgomery Road corridor. I always talk about it. It's a theme we talked about on your first episode, and you've bought numerous properties along that for yourself, and you've done very well. But the market has spread out a little bit too now to the counties where you know, you're seeing now, like I said, in on the east side, Purina's opening a factory. They're you know, so you need housing out in Claremont County now. So you're starting to see developers come there and start doing development, and land's a lot cheaper over there than it is in Oakley, you know, in downtown Cincinnati. So, you know, people go where the businesses go and where they feel there's going to be density.
One of the things I love about this market is you can take some of those conversations and the fundamentals really don't change. And for me as an
Yep.
investor, I think it's really important for people to identify their own investing thesis and then find the markets or the deals that match that. And when we talk about this market, it's a slower moving market, even though it's white collar. And a lot of times people are following trends and they want to, get in front of the puck, if you will. But in this case, it's not like, "Hey, you gotta hit it, and if you missed it 2 years ago, you just
Hmm.
missed it." Like, a lot of those areas you talked about have been trending in that direction for a decade plus, and now
Yep.
it's just a matter you start to see a bit of a tipping point where you have the Purina factory and these other developers that are coming in, and they're creating the things that are attracting residents, attracting jobs, and now it's more sustainable. So, I love that aspect of it. We've talked pretty much exclusively about Cincinnati up to this point. For someone in
Yep.
a different market, how would you extract maybe some of the lessons or the learnings that you've seen in this market, and what should they be looking for in maybe their own backyard or other cities to make sure they find some of the success you've talked about?
I think it just comes down to population. You mentioned missing the boat on some of these other cities, and you can name something like Austin or Nashville or some of those other cities that have really kind of taken off, especially in the past 5 years. Miami, Florida, Fort Lauderdale. You know, there's been a lot of push with real estate there. You know, I think with us, and I'll talk about the Midwest in general. What's nice about the Midwest is our appreciation is typically done through the income, and we don't have kind of flash appreciation like some of these other cities have, and that could be a good thing. And you can also have flash depreciation. You know, first and foremost, most of the states in the Midwest are very landlord friendly, which makes, you know, looking in your backyard, you want to invest somewhere where the legislator really protects the landlord. You know, I've heard some horror stories, and we get a lot of clients from California and New York. They're like, I had a rental property. I had a squatter for 12 months. They didn't have to pay. It cost me a dime, an arm and a leg to get them out. And then I get to the property, and it's complete wreck. And I've lost all my cash flow for the past 3 years. Whereas in the Midwest, really, with a lot of our states, you know, you're talking Ohio, Indiana, Kentucky, you know, uh, we're very landlord friendly in the sense that if someone's not paying rent, they'll give them an immediate notice for an eviction. Takes 30 days to get them out. Sheriff shows up. There's no games with it. If someone's month to month and you don't like them as a tenant, you can give them a 30-day notice and say owner wants occupancy back. Go find another place to live. So looking at looking at stuff like that, you know, legislatively, who's protected in the landlord tenant relationship? And it's not just multifamily. Happens with retail too. Happens with industrial. Happens with all leasing types. So I think that's one thing to look at. Demographics, household income. Are you guys, you know, wherever you live, are you trending up or are you trending down? If you're trending down, prices naturally have to come down to make it affordable. Is your economy supported by one or two companies, or are you supported by 30, 40 companies that kind of distribute the job creation and jobs in general? I think that's a critical piece to look at as well. So, you know, between just legislatively, how are you protected as a landlord, and then looking at the basic demographics of areas, household income, and then the trend. Are you trending up or down? No matter what market you're in, you've got to look at that and really analyze it. And I think the last thing is people, and it goes back to kind of underwriting, whatever asset type you're underwriting, office, um, industrial, retail, multifamily. You got to be really conservative with your numbers. And I like what's happened in the past 3, 4 years because it got rid of a lot of the, I don't know what to call them, but these makeshift Instagram syndicators that, when rates are 3%, you can make a million mistakes and you're still going to cash flow because the yield's always going to be there, especially if you're trading at a 6, 7, 8 cap, because then you've got 3, 4, 500 bips of room to mess up. But when you're underwriting and caps are in the sevens and eights, 8.5s, and then some office, might be 9, 10, and your rates are 6, 6.5, 7, you better damn well underwrite, the right way, conservatively, or those returns aren't going to be there. And really, a lot of those people that were kind of selling these investment dreams and taking people's money, and a lot of them got lucky in the past few years because it naturally appreciated. But now it's funny when you're talking to sellers and some people who syndicated and did some other types of deals. They're coming back and saying, "Man, my loan's due in 8 months. I had a 5-year fixed. I refinanced in 2021, or I purchased in 2021, and I'm not cash flowing right now. I don't know how I'm going to do it with my interest doubling. I got to get the hell out of this." So you start seeing opportunities like that too, no matter where you're at as well. So that's another opportunity investors can look at and say, is there maturing debt going on? What's going on? Is the property deferred? Different things like that. But you got to underwrite for that too. You got to be prepared for that. If you're not, and you're just looking at a basic P&L, you're going to be in trouble.
Great insights, right? I mean, definitely understanding like the story behind these deals, particularly for the loans, which doesn't always come up, especially in that initial underwriting. I mean, typically you're looking at a T12, the income, the expenses, which does not include the debt service. But as you stated, a lot of times, hey, this thing might look good on paper, and then you get the real story, right? You start
Yeah.
factoring the debt, factoring the capex, and you realize, okay, this thing is not performing as well as maybe we initially thought. So
Hmm.
definitely helpful. You talked about population, right? Understanding what's happening that macro market, and then I would say too, man, from a submarket standpoint, just paying attention, understanding where things are, like where are the jobs going, where are the developers adding
Yeah.
jobs, where has the government, the local government made investments. We had put together a download that's available on our website, casmoncapital.com/best dash markets. And you can go check it out. You just go to our resources tab, and it's 35 hacks to find the best markets and submarkets. And this is something I think is really important, is taking some of the stuff we're talking about and then trying to put together a blueprint. And one of the tactics that I love, you kind of hinted at, which is lean on the big guys, the Wawas, the Chipotles, the Paneras. Like, let them do all the research. Let them
Yep.
invest into, what's happening in this area. And when you start to see they're developing these locations, or they're putting up, new apartments or all these kind of things, that's a really good indication that, hey, they are making a big bet and the trends are saying people want to live here. So let them do the heavy lifting. You got to be careful because there is, the absorption and there's oversupply that comes
Correct.
involved. So you got to pay attention to some of those things. But as you've indicated, in some of the markets, particularly in the Midwest, we don't really see a big boom in development like some of these other regions where you literally will see, 3 or 4 new apartment buildings being added on the same street, and
Correct.
you don't see it like that or to that extent here, so you can, feel a little more comfortable based on
Yeah, we don't
what
have
you're actually
25
seeing.
cranes in the air right now. You know what I mean? That just doesn't happen. But you go into some other major cities, and I've traveled other cities in the world too, and different thing. And you can go into cities and see 15, 16 cranes of, 30, 40, 50 tower, tower kind of buildings, condos, or apartments, things like that. It definitely makes a difference. So, we're a much more stable market. It depends on your risk appetite, right? Are some people like the I've got immediate appreciation, but I'm risking immediate depreciation too. Where some people like that stable, blue chip stock that there's growth. It's maybe at or below inflation, and I'm good with that. But I know it's over time it's going to grow. And I think the testament to that is I can't tell you how many times people said, "Man, I should have bought 3 years ago. I can't believe
Yeah.
it's sold for this now. It's sold for," and we've been having that conversation for 10 years, 14 years that I've been doing it, and it's like I mean, hindsight's always 2020, but the market has been always trending upwards, which has been good for us.
Yeah, I mean, listen, I think it's incredible because I mean we talk about the market and locals. I feel like always undervalue properties in their market, right? And that it may be, I don't know if that's a Cincinnati specific issue, but I just feel like familiarity always breeds that content. And one of the things I remember when I first started investing and looking at Cincinnati, like you would find properties that would be on the market for like 30 a door, right? $30,000 a door, $40,000 a door, maybe even
Yeah.
25,000 a door, depending on which neighborhoods you're in, which is just insane to think about today. I mean, we bought a 20 unit building for less than $1 million.
Hmm.
And that is just unheard of. I mean, you could be in some rough neighborhoods and not find that. So
You can't even
that,
buy a shell for that now.
right. So,
Yeah,
so just understanding that, hey, you as an investor, you have to also believe in kind of the data and what you're seeing, and if the numbers make sense, as you talked about, it's really more kind of forced appreciation or appreciation through income, as opposed to just waiting for the market to do it. And those are the things you can control, and that's the reason we like the Midwest is you're buying it for the cash flow, and you're understanding the conversation we're having to say, hey, you know what, I'm also placing a bet that this area is going to continue to improve. And if that area improves, the desire and the demand increases, and that's going to drive up the overall value of that property. I want to
absolutely.
switch gears a little bit here, man. So you've been doing this now, growing for 14 years, 10 years as an independent brokerage firm. I know a lot of folks are seeing the call it competition, or they're seeing, we're seeing a lower volume of transactions that are taking place, and everyone reacts a little bit differently. From your viewpoint as a broker, both amongst other brokers and when it comes to investors, what are some of the realities of operating in this market as opposed to the market we saw 3 or 4 years ago?
Yeah, I mean, I think with us, we've really grown organically. We feel we have a great culture. I Not that I've never been worried about our competitors and things like that, because you always want to get listings. Sometimes you're in opportunities where you're competing with each other. Sometimes you win, sometimes you lose. It's okay. But we've only control what we can. You can only control what you can control. So I think a lot of people thought it was very easy, especially these newer brokers that got into the game 5, 6 years ago. COVID. We keep talking about COVID. I've talked to other people about it. Um, Between March and June of 2020, or was it 2020? Yeah, 2020. I think everyone wanted to jump off a bridge. I think at that point we had lost like 10, $15 million worth of loans, and deals were falling apart. Banks were comparing it to the Spanish flu of 1920. I mean, just crazy stuff. And then all of a sudden, all this money got pumped into the economy, whether it was through PPP or people were doing whatever it was, and and then all of a sudden rates are just still historically low, and you've got this momentum, and you could sell anything, and we've got business units that really perform that, especially with residential. Residential, we've got a residential unit we started around that time. I had seen contracts I would never have thought would exist, appraisal gaps, no inspections, as is, bidding wars, 100,000 over ask, like just crazy stuff that just you never learn that stuff in real estate school. They're always like protect your client, make sure you do inspections, uh, and people are going to start paying for that now, and I'll get into a little bit of that too. But um, if you had a listing, you had a sale. I mean, it really went that easy, and we were, especially on the larger portfolio properties, the 70 units, the 100 units, the 150 units, those were really selling because the yield was always there. And like I referenced before in our talk just now, you could make mistakes and you still had yield. And now brokering, you got to really broker. You got to underwrite. You got to understand how the lenders are looking at the properties, and that's why we brought capital markets in, because when we underwrite a property, we want to have our lender look at it and say, "Yeah, I do have a loan program for this. It's going to be 25% down based on this number. I would recommend going at this price." But now you're really underwriting. Now you have to take into consideration capex. Now, the location is important. So that's come into play a lot more from a brokering perspective, where it's not like if and other asset types too. Office, for instance, office is probably the most, you know, that completely died for 3 years, 2020 to 2023. I mean, think about it: work from home, remote. You got a company that has 20,000 square feet. They're like, why are we paying for 20,000 square feet of space and no one's in here? It's the cleaners, it's the janitors, and then now they're like, man, our production hasn't been that great. We lost our company culture. Get your ass back to work, and we need office space again. But it's not 20,000 square feet that's being rented anymore. Maybe it's 10,000. It's a hybrid model, and it's shared office, and you work a day or two from home and you come back. But at the same time, vacancy went up on that asset type. Now you're starting to see people with cash on the sidelines like, hey, I'm willing to take some risk on office because I can buy it at a 12 or 13 cap rate. And then I've got 30% vacant still, and I'm going to get it to a 20, 30% kind of return. So, I think opportunities have also come up in the past 3, 4 years of different asset types. Industrial was really hot during COVID. What was everyone talking about during COVID? Logistics. You need warehouses. You need 300,000 square feet of distribution centers and things like that. Those have even slowed down. The hottest industrial assets right now, they're 5 to 15,000 square feet, and they're typically catering to your plumbers, your trade workers, your electricians, small distribution companies, whatever the case might be. That trend's completely changed. So, as a broker, that going back to your question, you got to know how to broker, you got to know how to sell, you got to know how to underwrite, but also you got to be. And what's nice about our brokerage is we're so horizontal in the different asset types we do, both on commercial, residential, businesses. Um, we're so horizontal that we've got the opportunity to really capture market trends as things change, because nothing lasts forever. It changes on the daily, and it changes even within asset types in the industry.
Triff, I love what you said, man. A couple of things stand out. First and foremost, you mentioned just being flexible and fluid, right? Based on the market, based on what demand is, and understanding that, hey, yeah, a few years ago, the goal was to get the listing. You got the listing, you got the sell. It was that simple. Like there was a bidding war. You mentioned on the residential side, dude. On the larger commercial side, I mean, I know
Oh
some
yeah,
operators who would go and put, $250,000 hard day one,
correct.
route inspection, all of that, right? And just had money. I don't say money burn, but just they could do it. They put down a quarter million. I know guys who lost $500,000 with that
Yep,
approach, right? Which is just insane. But that's what
it's
it took
insane.
to win a deal. It took hard money, day one, waiving all contingencies to
Yep,
go and win a deal at that point. That's not the case today. And I think what's happened is the brokers who came up and got comfortable in that space, well, now they have to actually broker. And you talked about putting a deal together, but it's also keeping the deal together. It's making
sure.
sure that that buyer doesn't freak out, right? It's making sure that seller doesn't get greedy or have second doubts. And I know that's happened. It's happened to me in a couple of deals where, we had an agreement in place and the buyer got a little skittish about, the news of the day, right? The worries of the day,
Yep.
especially with the rates constantly being in fluctuation. And, those things have kind of fallen out of contract. So for you guys, because you deal with so many different asset classes, talk about how you stay on top of the trends in those asset classes while making sure you are keeping both the buyer and the seller on the same page to make that transaction take place.
Sure. And let me add another variable that between buyer and seller that you didn't add in there, and it's the lender. Lenders do not want to loan you money. They will find every reason not to loan you money. And they look at historicals, and they might ask you a question from 2024 that has no relevance to the way the property is operating today, and you've got to explain yourself. So the lender for me is even more difficult to bridge now than ever, because of the risk, the risk adverse. They don't want to take chances right now. So a lot of lenders have actually stopped lending on commercial in whole or in general. Fifth Third does not lend commercial right now. They don't do it. So that's another variable that's come into play that we didn't really have to deal with 4 or 5 years ago. It was, every lender was fighting for the deal. Every broker wanted the commission. It was easy. So,
And every
but going
lender
back
was
to
giving you, a 90%, 80% LTV. I
oh
mean,
my
they
god,
was tripping over themselves to give you the money.
And then the other deals that were very prevalent were the acquisition plus improvement loans. Hey, 100% interest only, 24 months. We'll give you all the money in the world. Don't worry about it. Values are always going to go up. Okay, we'll take it. I mean, as broker, we got to make the deal happen. But so that's another variable that's really come into play the past few years that has made transacting very difficult. Now, to talk about your other question in terms of the asset types, what we created here at our brokerage, and you've got to be a specialist in an asset or two in order for you to transact. That's the thing. So, although our company is very horizontal, we have agents within that specialize in industrial, specialize in retail, specialize in business brokering and leasing, specialize in multifamily. So you've got to have that specialty, and that's the only way you're going to keep up with the trends. You've got to be watching the news daily, see what's going on with a certain asset type. Is the housing market good, strong? Where's rates at? Um, Going back to what you're saying, rates were kind of trending down, and then we entered a geopolitical kind of issue with the war in Iran now. So inflation's gone back up. Well, what's that do to the T-bill? Shoots it straight up. It hurt a lot of residential people. They can't qualify for loans anymore because the difference between a 6 and a 7 might mean their price point or whatever the case might be.
Heard a lot of
So that
commercial guys are looking to refinance. I mean, you talked about the 5 years
absolutely
ago. I mean, we're recording this June 2026. So anybody who bought when that, COVID time period slowed down, talking June 2021 and thinking, okay, I could refinance now, or even the last couple of years. I mean, you're right back to riding this roller coaster.
correct. So you've got to be a specialist within the asset type, but not sometimes people only want to focus on, for instance, industrial. There's a lot of brokers that we have very good relationships with that focus on 50,000 square foot and up. That's all they do. But if that market's soft, it's gonna be you're gonna have a pretty tough year. So you've got to be able to adapt to, okay, maybe I got to get 15,000 square feet, 20,000 square foot owners in front of me now, because those are the properties that are transacting right now, whether they're doing leasing or a sale. So keeping up with those trends too, really looking at. I was talking with you before we started this podcast. The bigger properties on multifamily are very difficult to sell right now. There's not a lot of margin. People are underwriting much more conservatively, but the 10 to 20 units are selling like hotcakes. But what's the difference? They're not as institutional investors. Many of them aren't syndicators, so they don't have to promise a preferred return, or not promise, but at least try to tell them that they can get a preferred return. I know you guys can't promise when you do
I was
syndication.
going to jump in on that, boy. You'll
Yeah,
get
yeah,
the
yeah.
SEC
Legal
attorneys all
disclaimer on the
over us.
bottom. Legal disclaimer on the bottom.
Yeah.
But but when people sign up for syndications, they're anticipating a preferred return. We use that word. Whereas when you're an individual, or maybe you're doing a joint venture with a partner, maybe in the beginning a 7-8% return is okay until you fully stabilize it over 36 months or 24 months, until you can get into double digit cash on cash returns, maybe 12-15%. But so the smaller properties right now, they're transacting. Same with spaces that are for lease. Um, we've got spaces for lease that are 30,000 square feet, and we've got spaces for lease that are 2,000 square feet. The smaller spaces are leasing right now. Your big box retailers, your junior box retailers, they're struggling. They're shutting down more than they're opening right now. Whereas, your smaller retail settings, and retail can be office too, because, your insurance agents, your attorneys, your massage therapists, personal trainers, things like that, those businesses are growing. So again, being able to have a mix of these different subtype of properties within the asset type itself is critical. And I think that's something we do really well here, is we're kind of able to stay ahead of those trends and say, okay, if 50,000 square foot warehouses aren't leasing right now, we got to pivot. We got to go after every owner that's 10 to 20,000 square foot right now. And being able to do that, because it's going to allow us for transact, and we get paid when deals close. So we got to transact. I mean, you can follow the trends all you want, but if you're not transacting within those trends, it's gonna be tough for you.
So, one, appreciate everything you just said there. There are a couple of really good insights, particularly for multifamily investors. And it's one of the things that I think I'm seeing a lot more of. And it's just important for all of our listeners. And one of the reasons we're doing this conversation now is, I think everyone's going to have to learn to pivot. You may have been locked in, and most of us understand how important it is to focus on one thing, right? Focus on one asset class, one business model, whatever it is. But the reality is, you have to understand what's happening in the market and be able to adjust and adapt accordingly as well. The way you all are set up, you really span across multiple asset classes with specialists representing each one of those verticals. For most investors, if you are still siloed in one type of property, you're going to miss out on a lot of opportunities, especially if that asset class is not in favor right now. The deals just aren't working, the numbers aren't working. So diversification is key, and you can diversify within real estate. We are locked in now on the Cincinnati market, and we think that we want to find great deals in Cincinnati. I'd love for them to be in multifamily, but if they're in a different vertical, we're open to that. And years ago, I was not. This show is called Multifamily Insights. We focused on
Correct.
one asset. And what we've learned is, hey, you know what? Us trying to find a multifamily property in, Tennessee or wherever the case may be, yeah, we can do it. We know that industry. We know it very well, but we really know the market here better. And having the right partners, the right team in place, and being able to be local, that's probably more valuable than just, buying a property in a different market, particularly if someone else in a different state can do the same thing. So that was the pivot we kind of made. And I know a lot of brokerage firms that maybe focus on large apartment sales. That's the challenge I think they face is if
Yeah.
you only do apartments and you only do 50 units and up or 100 units and up or $10 million and up, well, when the market changes, it's really tough to find buyers and to make those deals transact, even if you built a reputation. And the thing you guys have done is really stay diversified so that maybe one year industrial's kicking tail, maybe one year it's multifamily, maybe another year it's the residential side. But you've really diversified enough where you could grow and scale your portfolio. And at the end of the day, as entrepreneurs, as investors, it's really about building a portfolio and a book of business that can pay the bills, right? That can deliver and help you build and create wealth. And it's never about one specific type of asset throughout the entire period of that business. So staying open minded to other opportunities is really how you win. I think that's what you guys have been able to do over the last decade, where maybe some of the other local brokerages have missed because they've really fixated on that one asset.
Yeah, and John, I think the couple points you hit on that I think are great. More owners are becoming more and more open to different asset types, which is amazing. And there's a lot of owners that own different asset types, and I know you're in that category now. So, I mean, kudos to you to being open minded and seeing an opportunity. I think the other thing is even Class A multifamily that's being developed now. If you look at the developers, there's some form of mixed use in a lot of these developments now. They're putting retail, they're putting amenity. They want amenities. From a retail standpoint, to be able to cater to their tenant base as well. So, and it creates a little bit of a risk aversity from the point that okay, maybe we can't get the retail done yet, but we've got a multifamily that's supporting us, and we've underwritten for that. But now that we had a couple retail tenants in there, they're helping offset taxes through CAMs and insurance, and it's subsidizing kind of our carry as well. So they're looking at ways to do that in terms of new developments. You see office buildings have retail components as well. If you look at like Rookwood and Factory 52 and Norwood that just is getting complete, they've got a retail setting on the bottom. And it's all apartments, and then they've got like a food kitchen in there, and people are subleasing those, and different brands come in. So people are trying to diversify, and it's no different than stocks or you're not all in on one stock in your retirement or your 401k, or it's tied to an index that has numerous stocks involved in there. So it can, if one of those stocks goes up, it can bring you up. But if another one goes down, it might average you out. So, I think that's how people are starting to view real estate as well. It's another way of investing, and people like to try to be somewhat diversified so that not all eggs are in one basket. And I think that's what we're really starting to see as a trend. For the past few years.
And I think part of it is that, for a lot of folks, the typical journey for an investor is they start off with some rental properties, maybe single family houses. They progress into
Yep.
smaller multifamily or larger multifamily. And that was one of the reasons apartments were so attractive, is like people understood it, they could get it. And once you have scale, you can pretty much manage it from anywhere to an extent. But that just hasn't been the case. And now it really takes a true investor when you start talking about mixed use or office or industrial. And I know that starts to also thin the herd because very
Right.
few people are interested in that. And again, I remember, there were times when I would see something, it was mixed use retail on the first floor, delete, like, I don't even
Hmm.
bother underwriting that, right? And now it's something that we know maybe there's a little bit less demand, a little less competition, but the numbers still work. There's still desirability for that space, for that retailer, for that office on the first floor. So it does give you a chance to find deals that work and make sense, and maybe you have a little less competition so the numbers can work out really well for you as an investor. For folks who want to learn more about you, Triff, the team, maybe getting on your list to see some of the deals you guys have in the pipeline and coming up, what is the best way for them to reach out and get in touch?
Definitely our website. So we have two of them, 3CRE.com and 3CREhomes.com is our residential website. All the commercial business brokering, asset management's on 3CRE.com. So you can look up that, all our agents, etc. My email is triff@3CRE.com. So TRYF at 3CRE.com. Phone number is 513-745-9333. So you can reach out anytime. We got a team here. So no assignment's too big, no assignment's too small. There's an agent always willing to take something on, because the nice thing about this business, and I've seen it happen numerous times, you might start with someone that buys a duplex, and then all of a sudden you blink, it's 10 years down the road and they own 350 units. I can attest to that. I have clients that have that's happened to, and we've grown together. They've helped grow our brokerage. We've helped grow their portfolio. They've made money along the way. So we see that all the time. So like I said, we welcome clients. We want to be an open brokerage. Like I said, we've got specialties in all different asset types. So we can definitely help you if there's a need on any asset type.
I love it, man. Right now, we're going to transition and go to our round of insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide, go to our website, casmoncapital.com/7questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Give me a failure or an apparent failure that sets you up for later success.
Growing for the sake of growing, I think. So in the beginning, when you're thinking of a brokerage, you want to just add people and bodies and all that kind of stuff just to show that you're growing. But I think when you're growing a company, whether you're trying to scale up your investments, you're an entrepreneur and you've got another company, and I think you've got to grow smart, because almost like when you underwrite, be conservative. Don't grow for the sake of growing. Make sure it's an educated decision on why you're growing. And I think in the beginning, I just wanted to have 20 people on the roster, just to say I had 20 people, but doesn't necessarily mean that the production was always there, right? So I think that's really taught us how to hire going forward. And then we created a really, really good culture here. We feel that, our retention rate with agents is great. I think people enjoy coming to work here. We're very collaborative. So creating that environment has been critical. So not only growing smart, but also having people come in that can contribute and help build that culture that eventually, hopefully we have 100 people here that are doing that.
Give me a digital or mobile resource you recommend for our listeners.
Man, we've been recently using a program called Retail Sphere. It's an AI program that helps us with our retailers. So that's an AI tool. It puts us in touch with a lot of national retailers and things like that. You're able to do drip campaigns. You're able to go to the main person at McDonald's if you have an outlet that you think McDonald's would be interested in. So that's been a pretty cool AI tool where they can communicate with you through this AI tool. We've got other tools as well that kind of Placer is another tool. You can see how many individual cell phones unique cell phones go into a property. So that helps a lot too with commercial shopping centers. So if you have vacant space there and you can say, hey, there's 800,000 unique visitors that go into this building, that again is data for oncoming retailers that you can give. So that's been good too. So a lot of AI tools. Obviously we use Canva and things for marketing. I think we have some of the best marketing out there. We've got a great marketing team here that do our memorandums, and we're able to just put nice packages together. So, a lot AI has really come into play really the past 24 months, and it's just getting crazier and better. Not to use it as a complete replacement, but to help kind of add that flair and flavor to whatever you're trying to advertise out there.
Give me the book you've recommended or gifted the most in the last year.
Yeah, I'll give it to you. I've got it in my bookshelf here. One of my favorite books by Jim Camp. It's called Start with the Word No. Everyone thinks a negotiation has to be a win-win or start with the word kind of yes. If you start with the word no, I give this to every new agent that joins our brokerage. All of them have read it. It's my dad was head of mergers and acquisitions for Procter & Gamble for a long time. Probably one of the best negotiators I've ever met. I mean, but this was recommended by him 10 years ago to me. Love the book, so definitely recommend it. So start with Jim Camp. Um, you'll get some good insight into negotiations, just the mindset.
I love it, man. I've not heard of that book, so I'm excited to check that one out.
Yeah.
Give me a daily habit that helps you stay focused on your goals.
Jim, I see you there all the time, John, and we actually got a deal done at 7:30 in the morning.
We did.
We had a gym on a Saturday. Funny how that works sometimes, but I just recently had my first son 11 months ago, and then I've got another one on the way this year again.
Oh, I didn't know that. Congratulations.
Yeah. Thank you. Yeah, surprise to me too, for sure. But we're moving quick. They're going to be 15 months apart. But I always do try to make time for the gym, whether it's early morning or late evening after I've done all my family duties and everything. But gym is really, really important to me. Not just from the physical aspect, but just mental, emotional. I put my phone on Do Not Disturb. I get on the treadmill. I watch my shows. And then just try to lift for a little bit. But that is a habit that I didn't break. I try to go 5-6 times a week.
I love it, man. Great stuff there. All right. Give me your number one insight for scaling a brokerage and or business.
Okay. Scaling a brokerage, like I said, you've got to have people around you. You can't scale unless there's good people around you. So one thing I'm really proud, I think we've added good people here. But I think in general, as a broker, and you hear about this, and we've been part of some national brokerages as well. I think for us, staying humble as the owners, hiring people from outside that can come and add value to your brokerage and being open to that is critical. Marketing, we've really grown in marketing. I don't know how to use Canva. I don't know how to do any of that AI stuff. We brought people that I can tell them my vision and what I want to portray out there, and they make it happen. Or just agents in general. Our director, Andrew, we brought him in. He worked for some of the national firms, but he's really an industrial specialist, but also he's on the Hamilton County Board as a chair on zoning. He's on Delhi's appeals team of zoning. Bringing someone like that to the team where I've got no zoning, I mean, I've got basic zoning knowledge, but when you've got a person that wants to develop or wants to put their brand on this vacant building and having to go through zoning and variances and things like that, having someone like that in your brokerage that can give you that advice and write the arguments and do things like that has been critical too. So I think scaling the brokerage, you got to grow. Obviously, you need personnel, but bringing personnel that add value to the overall brokerage, while you as the owner can stay humble enough to allow them to give their input so we can grow the brokerage. And I think that we're very good at doing.
I love it, man. Great stuff there. We're in a light mood, man. Last question. We're both here in Cincinnati. Give us your favorite place to grab a bite to eat.
So it was my first real estate deal ever. I'll always support them. They're my family. I always go to E&O Kitchen. We recently just did that was my first real estate lease I ever did. First real estate transaction Mike and I did. So it's got a special place in our heart. We did the Hyde Park location recently. We just did Loveland last year. So they've been open in Loveland now too, but that's one of my favorite places to go. It's a good vibe. They have good events, and Bengal season, best place to tailgate. It's right by the stadium at the Banks. So you can catch me there all the time. Between whenever, before the game and then usually a little bit after until I got to get home.
There we go. E&O Kitchen it is. Great stuff. Trip, always a pleasure to catch up with you, man. A couple things stand out to me. First and foremost, your success was, really, you're a grinder, man. You work hard, but you also do it the right way. So you talked about diversifying the business, which is something I think all investors and business owners need to think about. And if you have a business, you may look at different products or services that you offer, but you can't just rely on the one thing. You've got to figure out how do you create, a pipeline of offerings that, you know, can help you navigate lean times or whatever the market demand actually is. You also talked about market knowledge, right? Understanding both the macro market, the sub market, where that growth and development is taking place, following the big retailers, the companies that have huge dollars to invest in the market research, let them do that heavy lifting, follow their lead. And then last, we talked about really just understanding how to build out your team, what you look for from a culture standpoint, not just adding to add and just hitting some random number, but actually finding great quality people who add value, staying humble as an owner, learning from these individuals and giving them a voice always an opportunity to be successful within your organization. For folks that want to learn more, check out some listings. Again, it's 3CRE.com and then 3CREHomes.com. We'll link to both of them in our show notes. Tryf, always a pleasure talking to you, man. Look forward to staying in touch with you. And I hope to, well, of course, I'll see you soon, but hope you have a
I'll
great
see you at the gym, man. You're always
there.
there too. So don't
I'll
give
run into
yourself
you
too
soon.
much. Yeah,
There
we're
we
running
go.
too soon, John. Appreciate it.
All
Thank
right.
you.
Take care, Tryf.
See you, man.